Let's bring in Fed Governor Adriana Kugler, along with our own Steve Leisman. Steve, take it away.
Hey, Jonathan, thanks very much. I am here in San Francisco at the annual meeting of the American Economic Association, where something like 5,000 economists are descending on this city. I don't think they can set it straight, but in any event, they'll try. Thank you for joining us, Governor Kugler.
Thank you so much, Steve, and Happy New Year to you.
Thank you very much. I want to start with an area of expertise that you've had over the decades, I guess, which is as a labor economist. One of the things that motivated the idea of rate cuts beginning in the summer of 2024, which is now last year,
yes,
was the concern about weakness in the labor market. Do you see weakness in the labor market? Does it cause you concern? It seems like once again we have another strengthening going on.
Yeah, absolutely. So let me start by saying that we're ending, or the economy is ending the year in a good place. The economy is resilient. The economy is growing at a good pace. It's projected to grow at 2.5% this year. It grew at more than 3% last year. Disinflation has been happening, so it came down from 7.2% to now 2.4% in terms of the headline number. In terms of core PCE, it has come down by about half, from 5.6 to 2.8%. In terms of the labor market, that has been something that has helped to get to that place. The labor market remains resilient. Certainly, the labor market, as you well remember, back in 21, 22, right after the pandemic, was extremely tight. A lot of people left the labor market. There were excess retirements. People left in the prime age group to go and take care of their children because they had to make choices. So all of that created a lot of tightness. And you remember the period, the so-called period of the Great Resignation. So quits were very high, but job creation and job vacancy rates were very high.
Right.
And the vacancy to unemployment rate was basically at 2 to 1, 2 vacancies for 1 worker. Businesses were having a really hard time getting workers. So where are we now? Fast forward, right? The labor market has been cooling, and it has been cooling gradually. That has been very good. In a sense, it's been easier now for businesses to hire, but workers are also experiencing an increase in real wages.
Right.
So that all has helped. So where are we now? Real wages are still up. That's a good thing, at about 1.6, 1.7%. The unemployment rate has come up a little bit, has stepped up.
Well, I was going to ask you about that because there is the SOM rule, and that seems like it's already beyond that in terms of how much the unemployment rate.
No, it has not kicked in, actually. I mean, that's a statistical regularity, but it has not actually quite kicked in. It's
so it doesn't make you concerned about a recession when it comes to.
No, I think the key, again, is that this has been gradual. The unemployment rate has been increasing gradually. It came from about 3.4% back in April 2023, which was the lowest rate since 1969. It increased to about 3.7% in the fall 23. It's now at 4.2%, which is still very much within what we consider historically low, right? So it's still at low levels. Of course, we're watching closely, and that was part of the reason why we decided to decrease our rates in the fall.
But have you cut them enough now to a situation where you're no longer concerned about weakness in the job market?
I think we're seeing that it's a stable situation, that the labor market is resilient, that the labor market has rebalanced. We want to keep it at that level. That's what we want. And we feel it's staying resilient. The unemployment rate is not increasing rapidly like it has increased in prior recessions.